That six-figure salary you worked so hard for? It isn't a symbol of your success. It's a cage. A comfortable, well-lit cage with great benefits, but a cage nonetheless. And every year you stay inside, the door gets a little harder to open. According to the Federal Reserve, the top 1% of households in the US own 31.7% of all wealth. That's almost the exact same amount as the bottom 90% of Americans combined. This isn't just a wage disparity, it's the core of the wealth gap. And understanding this difference is the key to escaping that cage and achieving financial freedom. The wealthiest 1% don't just earn more, they own more. This isn't a political commentary, it's an investigation into the mechanics of how wealth is actually built. The rich aren't just playing the game better, they're playing a different game entirely. Most high earners are stuck on a treadmill of what's called linear income. You trade your valuable time and expertise for a paycheck. It might be a large paycheck, but the formula is the same. 1 hour of work equals 1 hour of pay. To double your income, you'd have to double your hours, a mathematical impossibility. So you're trapped, answering emails at 10 p.m., sacrificing weekends. You think that salary is an asset you own. It's not. It's an asset you rent from your employer, and your lease can be terminated with one bad quarter. No work, no money. The wealthy, on the other hand, focus on leveraged income. It's a key concept for building wealth. It comes from owning systems and assets that generate passive income, money that flows to you independent of your time, a piece of software that sells copies while they sleep, or a rental property that pays them every month. So if the high earner is trapped on a treadmill, how do the wealthy get off? What are the specific levers they pull to build fortunes while everyone else is just building a career? The system isn't a conspiracy, and the gap isn't magic. It's math, built on 5 specific levers. And the first piece of that math is the simplest: acquiring assets that do the work for you. An appreciable asset is simply something you buy that's likely to be worth more in the future. It's the opposite of most things a high income allows you to buy. The new car with that intoxicating new car smell that loses 10% of its value the moment your tires hit the public street. Or the latest phone, sleek and fast, that will be obsolete in 2 years. Those are depreciating assets. They give you the immediate feeling of being rich, but they quietly make you poorer with every passing month. Appreciable assets, like a piece of a business or a parcel of real estate, do the opposite. This is the quiet engine that widens the wealth gap every single night. This isn't about being a stock-picking genius. According to 2025 Federal Reserve data, the wealthiest 1% of Americans own nearly 50% of the stock market. This isn't because they're all brilliant investors. It's because they are owners by default. Their system is designed to convert income into ownership automatically. The math behind this is simpler than you think, and it doesn't require a massive lump sum. Let's say you invest just $500 a month, less than a car payment, into a simple broad market S&P 500 index fund. You're not picking stocks, you're just buying a tiny slice of the 500 largest companies in America. Let's walk through the first couple of years. In year 1, you contribute $6,000. At a 10% average annual return, your money earns $600, so you have $6,600. Not life-changing, right? Then in year 2, you add another $6,000. Now your $12,600 earns 10%. That's an extra $1,260. Your money is starting to make its own money. So how do you actually do this? It's not complicated. Step 1. Open a brokerage account. You can do this online in about 15 minutes with firms like Vanguard, Fidelity, or Charles Schwab. Step 2. Set up an automatic transfer. This is the most important part. Decide on an amount, even if it's just $100 a month, and have it automatically moved from your checking account to your brokerage account every single month. This automates the process of converting your income into ownership. Step 3. Buy a broad market index fund. You don't need to be an expert. You can buy an S&P 500 index fund with a ticker symbol like VOO or FXAIX. That's it. You've just built a system that automatically buys you a piece of the American economy. Fast forward and that compounding effect snowballs. At that same 10% average, your $500 a month becomes over $207,000 in 15 years. You contributed $90,000. Your ownership contributed 117,000. You effectively built a financial clone of yourself that went to work every day for 15 years without ever taking a sick day. In a few minutes, I'll show you the exact calculation to determine your own versus earn ratio, a single number that reveals more about your financial future than your annual salary. Now you might be thinking, but a 10% return isn't guaranteed, and you're absolutely right. The market is volatile. Some years it's up 20%, other years it's down 10. The system works not because of market timing, but because of time in the market. You're betting on the long-term growth of the American economy, and that has been a very good bet for over a century. For those of you who already invest, what's one piece of advice you'd give to someone just starting out with index funds? Share your experience below. It could be the thing that helps someone else get started. To get a clear picture of where you stand right now, I've created a simple asset versus liability tracker that automatically calculates your own versus earn ratio. It's a one-page spreadsheet you can download for free at the link in the description. It takes less than 10 minutes to fill out and will tell you more about your financial trajectory than your last pay stub. But buying assets with your savings is the slow path. It's the staircase. The wealthy know where to find the elevator. It's an accelerator most people are taught to fear: debt. Conventional wisdom says all debt is bad. Your parents told you, your teachers told you, every financial guru screams it from a stage. But the data from the Federal Reserve shows something completely different. In late 2025, total US household debt reached a record $18.8 trillion. But the key is where that debt is. 13.17 trillion of it was in mortgages. Your parents weren't wrong, they just told you half the story. They taught you how debt can be a shovel to dig your own financial grave. They never showed you how it can be a lever for wealth creation, long enough to move the world. The difference comes down to a simple question: is the debt being used to buy something that puts money in your pocket or takes money out? Bad debt is what most people are familiar with. It's the credit card used to buy a television or the loan for a new car. It's a financial anchor. Let me tell you about a friend. We'll call him Mike. He's a brilliant software engineer making over $200,000 a year. He looked successful. He bought the expensive car, the designer clothes, the $5,000 TV, all on credit. He was financing a lifestyle to match his salary. But last year, after a round of layoffs, that income vanished overnight. The payments didn't. That television wasn't a symbol of his success. It was an anchor pulling him under. He was trapped by payments on things that were losing value every single day. Mike's story is why understanding these rules is so critical. If you're getting value from this breakdown of the real rules of money, subscribe so you don't miss next week's deep dive. You borrow money to acquire something that immediately goes down in value, and you pay interest for the privilege. That's the definition of bad debt. Let me know in the comments, team good debt or team no debt? There are strong arguments for both. I'm curious where you stand. Good debt is the opposite. It's money you borrow to acquire an asset that's likely to go up in value or produce income. This is the second lever of wealth, using debt as a tool for leverage. Let's make this concrete. Imagine a doctor who earns $200,000 a year. She wants to buy a $250,000 rental property. She doesn't use her own cash. Instead, she puts down 20%, $50,000, and gets a mortgage for the remaining $200,000. Now look at what happens. She controls a $250,000 asset using only $50,000 of her own capital. A tenant moves in, and their monthly rent payment covers the mortgage, the insurance, the taxes, and maybe even leaves a little cash flow. For the next 30 years, someone else, the tenant, is paying off the loan that builds her ownership, her equity in the property. Meanwhile, the property itself is likely appreciating in value. She has turned a $50,000 investment into control over a $250,000 appreciating asset, and someone else is paying for it. That's leverage. It's using a small amount of your own money to control a much larger asset, magnifying your potential returns. This is how you use the bank's money to get rich. But the system has another built-in advantage, one that explains the impossible math of how a billionaire can pay a lower tax rate than their assistant. It's not a loophole, it's a roadmap. Most high earners see taxes as an unavoidable penalty for success. The more you earn, the more they take. But what if the tax code isn't a punishment? What if it's a set of instructions designed to incentivize specific economic behaviors? According to the White House Council of Economic Advisors, from 2010 to 2018, the 400 richest American families paid an average effective federal income tax rate of just 8.2%. For comparison, the average American family paid a rate of 13.6% in 2020. This isn't because they're all committing fraud. It's because their wealth doesn't come from a paycheck. The tax code treats different types of money differently. The highest tax rates are reserved for earned income, the salary you get from your job. A lower rate, long-term capital gains, applies when you sell an asset you've held for more than a year. The system explicitly rewards long-term ownership over short-term earning. The ultra-wealthy use a third category, debt. Consider Mark Zuckerberg. His wealth is almost entirely in his Meta stock. If he wants to fund his lifestyle or philanthropic work, he doesn't sell billions in stock and trigger a massive tax bill. Instead, he can borrow against his shares. A bank will gladly give him a low-interest loan using his stock as collateral. That loan is not income, so it isn't taxed. He gets cash to spend, his assets continue to appreciate, and he avoids the taxable event of a sale. It's a mechanism available to anyone who owns appreciable assets. This principle applies at a smaller scale too. The doctor who bought the rental property can take a tax deduction for the depreciation of the building, an allowance for wear and tear, even while the property's value is going up. The government is incentivizing her to provide housing. The tax code isn't a punishment for success. It's an instruction manual from the government telling you exactly what behaviors they will pay you to do. The goal isn't tax evasion. It's to read the damn manual. These first three levers, assets, debt, and taxes, are how you play the game. The next two are how you change the game entirely. This is the final shift from employee to owner. The fourth lever is equity. It's the simplest to define, owning a piece of a business. The fifth lever is scale, creating a system that can serve many people without requiring your direct time for each transaction. When combined, these two levers are the most powerful wealth creation engine in history. Consider the case of Jeff Bezos. He didn't become one of the wealthiest people on earth because of his Amazon salary. He became wealthy by owning a massive piece of the company, his equity. Now, contrast his path with a senior software engineer at Amazon, someone earning a fantastic salary, maybe $500,000 a year. That engineer has a high income, but it has a ceiling. Their wealth is linear. Bezos, on the other hand, had ownership. As Amazon grew, as it scaled to serve hundreds of millions of people, the value of his ownership exploded. The engineer's income is capped by their individual contribution. Bezos' wealth was uncapped because it was tied to the scale of the entire system. Here's a challenge for you. Think about your own skills or knowledge. What is one way you could package that expertise so it could serve 10 people or 100 people without you having to be there for every single one? Drop your ideas in the comments. Let's brainstorm what scale could look like for you. This is the ultimate escape from trading time for money. Whether it's writing a piece of software that can be sold 1,000,000 times, creating an online course, or designing a business model that can be franchised, scale allows your work to have an impact far beyond the hours you put in. This isn't just for billionaires. Federal Reserve data from 2021 shows that for self-employed families, the mean net worth was $2.7 million. That average is massively skewed by a few big winners, which is precisely the point. While being an employee provides a predictable floor, equity ownership provides access to an unlimited ceiling. These 5 levers are the system that creates the wealth gap. It's not a conspiracy, it's a set of rules that rewards ownership. That cage you're in, the one built by your salary, has a key. And the first step to finding it is to figure out exactly how big the cage is. Tonight, I want you to do one thing. Calculate your own versus earn ratio. It's the most honest number in your life. List what you own, your assets. Subtract what you owe, your debts. Then compare that number, your true net worth, to your annual salary. This single ratio tells you everything. It's the measure of your freedom. Your mission is to make that ratio grow every single year until the day your assets earn more than your salary ever could. That's the day the cage door swings open. The only question left is, will you be ready to walk through it?